So what is a cap rate? A cap rate is basically the ratio between the price that's paid for a property and the income that it is earning. And what's often confusing about a cap rate is people don't understand if they want a high or a low cap rate. And that's because it depends on who you are. If you are a seller, you want as low of a cap rate as possible because you want to sell your property for the highest price relative to the income that's coming in. If you're a buyer, you want the highest cap rate possible, meaning you're paying a lower price for a higher income stream. The other thing we see with cap rates is often there's different moments in time when you're considering a cap rate. So, for example, we might look at a cap rate of how the building is running on a particular moment in time, but then we might think about what a pro forma cap rate might look like, which might include market rents, stabilizing expenses a little bit more, maybe trimming insurance costs or doing a property tax appeal. And so in that way, we're minimizing the expenses and making the net operating income a bit higher. And we can take that even further and say, okay, there's a cap rate that's a rehab cap rate. This is where maybe we're renovating the property and we're starting to put in rents where we've renovated the property and it's commanding a higher rent. We're minimizing those expenses, and now your net operating income is basically running as well as it can. And so at that point, you'd likely have a much higher cap rate.
Return on equity evaluates how efficiently the investment is performing by comparing cash flow to the equity in the property. Long-time owners who have kept their rents below market typically getting their return on equity about 2 to 3%. Let's compare that to the current money market that's giving you about 4 to 5% without any of those risks. So it's important to know what is your return on equity so that you can compare your current investment to the other opportunities out there and what's the opportunity cost on that.
What is internal rate of return? We've been talking about cap rates and also the return on equity, which are both measurements of yield, but only for a specific point in time. The difference with internal rate of return is that it takes into account the time value of money, or what the investment has been returning over a period of time. Typically, we see that between 5 to 10 years, depending on the determined hold for an investor. Over that period of time, you're calculating all the cash flows from the income, taking out your expenses, taking out your mortgage payments, and then also at the end of the hold period, you'll be taking into account the sales price and ultimate net proceeds. What we've seen is this number or return that most investors require over a period of time is between 15 to 16% IRR, or internal rate of return.